Welcome all. Steve Parisi here with IBC Global. Hope your day is off to a fantastic start. We've got our good friend here, Denzel Rodriguez. How are you doing today, Denzel?
Hello, Steve. God bless you, and God bless everybody watching.
Thank you, my friend. How's your day going so far?
My day's going well. I woke up very early, got a nice haircut so I can be ready for this video.
Right on, man. Right
Yeah,
on.
yeah.
Yeah,
Timing
nice.
was perfect today.
Good to hear. Good to hear. Well, thanks so much for taking time, as always, to do this podcast with me. So today, I know you wanted to talk specifically a little bit about your policy, how we originally set it up, what your goals were with the different funding amounts. We could say your policies actually, because you've got two of them. But we can certainly get into that. Should be a lot of fun. So let's jump in. So which one you want to start with?
I would like to start with the Guardian policy.
Gotcha.
Our last conversation was about the Mass Mutual Design 15K with a 1500 base premium, and we're able to fund it for up to 31 years, no issue, without creating a mech for the least cost possible. And we were talking about really not creating a mech. Like, how do we do that? How do we avoid our how do we minimize our chances of creating a mech? And so today I want to focus on my Guardian policy, which is the bigger account, it's the bigger policy, where I'm putting in $70,000 a year, same type of split, has a $7,000 base premium, um, and it is designed for a 7-year funding period with a reduced paid up option right after year 7, never putting in another dollar again. So basically $490,000 of principal go into the policy, and I pay 49,000 of base premium cost along with a term rider in those first 7 years. That term rider gets removed after the 8 year along with the $7,000 base premium, and it's basically a ever increasing death benefit, which is tax free, and ever increasing tax free savings account. It's a personal line of credit that I can borrow from continuously. I treat it like a HELOC in a sense. I use it to run bills, run expenses that I could, use my credit cards at first to get cashback rewards and 0% offers. And I just pull it out of policy and I just try to rotate the money, flip the money over and over again. Um, and so that was the original intention in my mind in my, say, year and a half of learning and practicing the infinite banking concept. My goal number was I wanted to put in $500,000. So I was like, how do I do that in the shortest time frame according to my financial numbers, right? According to the amount of money I bring in, what I cash flow, what I save, things like that. And that's how I came up with 70K, 7 years, straightforward, least amount of cost possible. Now, I wanted to ask you, what are the advantages or pros and cons of short-term funding versus a long-term funding, right? When you're talking to your clients, or even when I'm talking to my clients, I've been trying to formulate kind of like some of the things to present in terms
Yeah.
of like, why would someone fund a policy for such a short period of time? And why would someone fund a policy for a very long period of time? And what are some pros and cons to that?
Yeah, great question. And I know you're kind of set up to do both with the two different policies you have. So, beginning with the short-term funding, when you take the idea of a whole life insurance policy, typically individuals think in terms of how long they have to fund it. How long? Well, it's in the name, their whole life. You mean I got to pay premiums for the rest of my life? And a lot of people are turned off by that idea. Naturally. The thing is, when we design a policy, one can actually set that policy up to fund for a short period of time. Like one of your policies, you have it designed where you can fund for 7 years and then stop altogether. you with your specific policy, you could actually stop after 2 years if you wanted to, but you do not have to fund up until you're 100 years old. Now you can keep paying it, so often design it where if I want to keep going, I can. But when individuals start to see, and this intrigued me in my early years in the business, when corporations, how they set policies up for very, very short funding periods, it's attractive to many because, again, we think whole life insurance, I've got to fund my whole life. And then you show an example to see, hey, we can pay into it for 4 or 5 years, for 7 years, 10 years, to a certain age. You can customize it, you can fluctuate your payments up and down. That in itself is very attractive to so many people. And in my mind, it opens up the idea or the willingness to say, okay, whole life insurance is something I will consider because I don't want to have to pay in for my whole life. Maybe I'll change my mind as I go, but hey, if I see a short funding option, show me that and sign me up. So I'll always show it as an option in addition to a long-term plan as well. And you can a lot of times create it to get the best of both worlds with one option, which is really nice. But seeing that option to be able to fund for a short period of time is attractive to so many individuals. That's why we do it. And the advantage, obviously, is I can pay into it for a short period of time. So yours, after 7 years, you're done. And I mean, you'll have a large amount of cash value in there, which is good, that just continues to compound. You can use like that personal line of credit you mentioned, keeps on growing over time. And if you want to continue to add to it, you do have the ability to do that, but you're also not required to based off the guaranteed and non-guaranteed values.
Nice. Thank you for that. I appreciate it.
Yeah,
So,
man.
what happens when you're dealing with an individual? And I'm going to use me as an example now that I've been, 2+ years into the concept, and now I'm leaning towards, man, it doesn't hurt me to keep going, to keep funding, uh, because the more money I put in, the more cash value I'm going to have, the more death benefit I'm going to be able to pass on to my family. So plus I'm not going to stop making money 7 years from now. I'm pretty young, 7 years from now, but technically when I was 23 when I started, so I'll be 30 or 29 or 30 when the policy would say mature after those 7 years of max funding. But let's say I had a client, and I'll just use me as that person that wanted to do a short term funding period, but then in year 4 or 5, they come back and they say, "Hey, Steve, I, I think I want to keep going. How do I ensure, without creating a mech for the least cost possible, how do I ensure that I can keep going?" Now, I understand that based on my current design, 70,000, 7K base premium, 63,000 going into PUAs with the blended term rider, right? 1 year term insurance.
Mhm.
Um, After the 7th year, that term rider drops off. And according to Guardian, based on what you have, taught me, is that Guardian allows you to put in 4 times what the base premium is with no term rider. So just pure PUA, paid up
Mhm.
additions. So that means that my policy, the most I can put in guaranteed, right? Like for sure is would be 28,000, right? 7 times 4.
Correct. Yeah. And you mentioned a good point there. So your policy is specifically designed with one company. So if you look at Guardian's contract language, and we've got a lot of material on this with the nitty gritty, but how their contract language reads is when I have a 1 year term rider attached to a whole life insurance policy, they will allow me to illustrate 10x the base premium into PUAs per year. So, like your policy, using your example of the $7,000 base premium, literally you can commit to that, and the term rider only can say, hey, let me pay that. And then at my discretion, I can add up to 70,000 per year into the policy. Whether you hit it or not is actually entirely up to you. You've got that unscheduled PUA ability just to throw in anytime you want. Guardian is an extremely flexible company. There's other companies like them out there as well, but they're very attractive in that respect, and they've got strong guarantees and all that good stuff too. So while the term rider is attached, it's got to be that 1 year term rider for them to open up that additional flexibility. The 10x rule, not Grant's 10x rule, is the insurance 10x rule, Uncle G. But once that term rider falls off, or once we chop it off, one or the other, then their default contract language states that you can add whatever your base premium is, an additional 3x in PUAs on top of it per year. So if I've got a 7K base premium, up to another 21,000 per year to give you your total of 28,000 per year without underwriting. And then what I like the catchphrase that they have, and most companies have this as well, is we may accept more than that 3x limitation. However, it may be subject to evidence of insurability.
Got it.
That's what they're looking at. And let me ask this before I just blurt out the reason why. Do you know why they would require potential underwriting without a term rider if you're going to dump a ton of money into PUAs?
I'm assuming if I, you know, caught a disease
Yeah.
in my 30s, if I got really, really sick and I do well financially, and I'm like, shoot, if I know everything about the infinite banking concept, I know the ins and outs, and I know how much death benefit I can get 3x whatever I put in pretty much. For every dollar that goes into cash, I get another $3 back. The insurance company, from a business perspective, is not in the business of insuring people that are going to die in a very short period of time. That would put them out of business.
Yeah.
That would affect every other individual that's actually healthy, that doesn't have any issues. So when I look at it that way, I would say like that would be a reason. Is there another kind of?
That's it. You just hit the nail on the head. I mean, when you've got that 1 year term rider attached, how it works is when you plow money into PUAs, your net death benefit is not impacted, not in the short term. Whole life goes up, term goes down, net death benefit of 4 million or whatever figure stays the same. When that term's gone, right? If you at your age, if you plowed in say $10,000 into PUAs, a PUA payment, you see it show up in cash value, but the term PUA stands for paid up additions. It purchases you what is called paid up additional life insurance. Paid up because you're not required to make PUA payments. They don't bill it for your whole life like a basic premium. So it's 100% paid up whether you pay it or not. And then the additional life insurance, if you're paying 10K, it might get you between 30 and 40,000 of added whole life insurance, actual death benefit. So to your point, if you find out, hey, I was diagnosed with a serious illness, I got diagnosed with cancer, I got a year to live, let me try and dump 100 grand, let me try and dump 300 grand in a policy and mech it out because the death benefit's still tax free. They're not going to allow that. They're going to come back and say, all right, we got to check your health first to make sure you're not just trying to cash in for your beneficiaries.
Got it. So that could also be a case or an argument for why someone would set up their policy initially to handle or leave the window open to keep funding a policy for a very long period of time, knowing that I can't predict the future. I may or may not catch something. I may get sick in my 40s, in my 50s, in my 60s. So me being a 24-year-old healthy individual now, I might as well cash in as much PUAs as much as I possibly can fund a policy for, especially if I have the money to do so. And it's not going to hinder my finance. It's not going to hurt me to start this type of, concept.
Mm-hmm.
So that would be a good, I would say, advantage to that. So let me ask you, someone like myself with my policy design, it's now in the second year, approaching the third year come June of 2021, where I'll put in another 70K. If I say, hey, Steve, I want to do 70K actually for 20 years now or 30 years, would you say, okay, we might want to consider either restructuring the policy. Would that require to do like a 1035 exchange right into the same company? Or or is there a simpler way to do it?
Yeah.
Like what would be some of the things you would tell me or tell a client that say is experiencing that same thing? They thought they only wanted to do 10 years and then they figured, shoot, I'm doing really well. It's 10 years later. I'm doing well. I'm not as healthy, but I want to keep going. I don't want to do a reduced paid up no more. I want to keep going.
Right. So good question. With the reduced paid up, that's a after the fact change. So we might illustrate a reduced paid up, like your policy, for example. We illustrated it year 8, chop it off. In reality, we actually have to make that change. Just because we illustrate it, that's not automatic to happen. We actually have to say, okay, let's do this. Or you may elect to say, no, I want to keep paying in 28K per year or whatever amount I desire to pay in without any underwriting. To answer your question, though, if you said, hey, I want to keep going at 70K per year, right? And you decide to do that today or at year 7 or year 8, with that specific policy with Guardian, to be able to 10x it indefinitely, can't do it. So in a case like that, what we would do is got a couple options. You mentioned 1035 exchanging it into another policy and kind of restructuring it all. I don't know that I would do that. I wouldn't personally. If you were a new prospect, I would show you that in addition to several other options, see everything up front. This way, you're not just told, go with this option because it's the best. I don't like that strategy. So I'd show you it as an option, but likely what would be the best option to go with would be at that point in time, open another policy. If you're at a point in time where you say, hey, I want to stick with this particular company because I like their flexibility, and the first one I designed was to fund it 7 years, opening another one, when you're capped out on an existing, nothing wrong with that. If you had this existing policy and you're only paying in $30,000 per year, when you can go up to 70, and you say, hey, I want to buy another one, that's where I'm going to come and slow you down a little bit. I say slow you down, have a conversation with you and say, okay, you can open up a new one, but you're not optimizing the existing one first. We may want to look at that just to get more use out of your dollars going in.
Got it. Got it. And to your point before, mentioning how come the 7th year going into the 8th year, when that term falls off, to then go to the insurance company and say, hey, I actually want to put a little more than 28,000. I want to do 50. I want to do 60.
Right.
It's based on evidence of insurability. So let's say I'm still super healthy at 30.
Mm-hmm.
Does the insurance company ask every year when I want to put in more than that 28K? Will they
Yeah.
ask for medical underwriting each and every year?
Good question. They likely will. And every company's different. And I don't want to say Guardian and Mass and different guys work in different, they do work in different ways, but I have found from experience that changes over time. Depends on their comfort level, what's going on with the insurance carrier. So typically, whenever you complete a medical exam, whether that's for a new policy or to dump money into PUAs on an existing policy, if you go through the works, blood, urine, they pull medical records, all that good stuff, those exams that we go through are typically valid for up to 12 months. That's how long any insurance company will look at that and say, hey, we'll accept this as evidence of insurability. You're fine based off the health rating. So it's valid for 12 months. However, that's kind of where a conversation comes in where you and I would look at it and say, all right, well, you're paying in $50,000 this year when you're 30. Do you want to have the ability to do this for a longer period of time with your existing policy? And you look at it and say, yeah, I do. I might want to go for another 10 years. Well, then what we would do, if we're looking at the existing policy, you can go through underwriting. Pretend you're doing it for one shot, but actually what we'll do is attach more term to the existing policy. That same 1-year term rider, you can layer it on an existing policy. This way you can continue to add more PUAs to it, 50K per year or whatever amount that is, without any underwriting from that point forward. So we're just kind of adding more to the policy compared to what we first started with. And you can do that kind of stuff. that's from an underwriting standpoint. One thing I just want to clarify is that does not always trigger what's called a material change, and that has to do with the MEC limits on a life insurance policy. So, yeah, I mean, the insurance company might allow you to do that, but that's also where we're going to stress test the policy and look at it. Hey, if you keep doing this, are you going to run into a MEC at some point in time down the road? And if so, that's where I'll say, hey, based off the way we set it up and then what your goals are now because they've changed, here's the max you can pay into your existing policy indefinitely. And if you want to go higher than that, this is where a new one makes sense.
Got it. Got it. Okay, that makes sense. Yeah, I like that. So like in my case, 7 years from now, I 10x my income because I'm on that Grant Cardone mindset, and I want to keep building my wealth and whatnot. There's really no way to avoid creating another policy if my income does grow to that capacity. But
Right.
for the, say, majority of people that are coming into this concept, if they're looking to maximize the dollars that they do make today and give themselves the ability to maintain that funding amount no matter what happens. I lose a job, I get a promotion, income fluctuates, that number stays consistent, stays the same. It may be more advantageous cost wise to create a policy that can withstand the test of time in terms of the length of funding. Now, with that being said,
Mhm.
because this is the first time where I was dealing with a client that wanted to see an extremely long funding period, say like 40, 50 years. So
Right.
like basically till they're 99, basically max funding all those years, not dropping it down at all. What are some of the changes that need to occur in order to uh, ensure that that person can in fact do that without creating a MEC? What happens to the base premium? What happens to the riders that are attached to it? What does that look like in general for like all ages?
Yeah. So just to clarify, you're asking if a client, we set a policy up with a company that allows you to max fund it. So you have strong early cash values, but you want to max fund it for 50 years or something like that. And we plan it from the
Yeah,
beginning.
but
Yeah.
yeah, correct. Before the person even starts the policy,
Gotcha.
they're like, you know what? Short term looks cool, but I want to go all in on this infinite banking, becoming my own banker. Uh, I want to be able to fund this thing till I can't walk, so to
Yeah.
speak.
Yeah.
Uh,
No, I mean, when you look at a life insurance policy, I mean, it's a good idea in some respects to do that because the longer you have it, the better it gets. You keep feeding the beast. The death benefit grows at a extraordinarily fast rate when you keep pumping money in, base premium and PUAs. So you're going to leave a large death benefit. So from a legacy standpoint, there's a lot of good to be said about that. So you can do it. We've had a lot of individuals we work with set up a policy where they say, "Hey, Steve, I'm going to be able to pay into it until I'm 100 years old. I might not make it that long, but that's how long I want to be able to pay into it." But if life happens, I want to be able to stop in 5 years too. And you can do that. We do that for everyone. Make sure that it's designed to accommodate every scenario. And that's where different companies come into play because there's so many rules and such that they all have. But on your point, so if someone wants to be able to pay into it for 50 years and have these strong upfront cash values that you have to use the right insurance company. And what I mean when I say that is what we just touched on with your Guardian policy, where you can 10x that base premium. You can't do that with them for 50 years. You can't do it with the way that the riders are constructed and such. We've put Guardian policies in force with individuals that love the flexibility there of Guardian, but we went with a 25% base premium because based off their goals, all the companies we looked at, that was the best fit. And that's again the conversation when it comes up. So a different company or different companies would need to be considered there. Some of the major mutuals accommodate no problem. So how we would set it up is you can still carry a low premium if you want, call it 10%. That gives you maximum upfront cash value. You would need a term rider attached, and you could do it with a 1-year term rider, or you could do it with a level term rider. Either one works. A 1-year term rider, we can keep it on the policy for a long period of time. Now the costs are going to gradually come up. However, what I like to look at is, yes, the costs go up, but what do my guaranteed and non-guaranteed cash values look like? Do I still walk away with more money than what I would have otherwise? If that's the case, like, I don't care what the cost is because I'm earning more. But we disclose that to everyone. So a 1-year term rider will allow you to pump in a ton of money into premium PUAs for a long period of time, no problem. And if it's, let me think about this. If it's 100,000 per year, I can set my MEC limit probably at 110,000 right off the bat, and not worry about a MEC long term. Has to do with the death benefit, kind of like we talked about in prior podcasts. But that works. Or if I use a level term rider, that's going to fall off in 10 or 20 years. Some companies have a 30-year level term rider. That's going to fall off. So if I say I want a low premium and I want to pay into the policy for 50 years and I want a level term rider, what you have to do, this is so important, is overinflate that MEC limit. If they want a level term rider, what we're going to do is set that MEC limit probably at 160 or 170,000. And that brings up another question. They have to be approved for that amount of death benefit based off their financials and what the underwriter is going to look at. And the reason we have to do that is when that term rider falls off, my death benefit's going to drop. When you look at how the MEC laws work, after the first 7 years, I'm going to see it gradually decrease in most cases based off my age, death benefit, how much I have in cash value and such. So you almost always have to overinflate it if you have a case where you're dropping or cutting off that term at any point in time. You've got to do it in order to not trigger a MEC or be forced to pay in a lower amount. It's a lot of technical stuff I just threw at you.
It is, but it helps for that individual that is very technical, that because I think that we're dealing with technical people in this type of space. We're not dealing with someone that sees the first design and goes with it. The first illustration. This is something that I tell my clients, even whoever you end up going with in the infinite banking space, you want to make sure there's an infrastructure there. Number one, it's credible. The people that you're working with, they're not planning on switching careers, you know what I mean, and becoming a doctor, because they were just doing life insurance to, it was a stepping stone for something else. But then internally, figuring out that your individual goals and how the insurance company's rules and the MEC laws apply to your goals. Because it's like you have to surrender to their rules, to the insurance company rules and the MEC laws with the IRS. It's not the other way around, that they're accommodating for you. It's like, no, we're accommodating for them. And I think this helps bring up a little history lesson. Was it in the, I think the 70s or so is when they actually introduced these MEC laws?
80s.
In the 80s. So so it wasn't until recent. So it's only been 30, 40 years.
32, because I was
32.
born in 88.
So,
yeah.
Okay, so
So
you've got exactly this small time frame, roughly, where we're dealing with these new MEC laws. Now, why did that occur, Steve? Why can we get a little history lesson on?
Yeah, definitely.
Why the MEC limits came into play? What was happening?
Yeah, so life insurance, even today with the MEC laws, has a huge tax advantage. Why so many people put money in life insurance is if you do it right, if you don't trigger a MEC, if you don't lapse it with the gain, if you don't cash it out, you can use that money tax-free. Every corporation that I modeled policies for when I was just sitting in a back office typing them and designing them, well, I didn't type much, but designed them, their ultimate goal was, hey, on the back end, we're distributing income from the cash values and we can use it tax-free. And the death benefit comes back to us tax-free. the taxes is what draws so many people to life insurance. Prior to the MEC laws, right before that even existed, you didn't have that. That didn't exist with cash value. So it was really used as an investment. What a lot of people would do, it made it difficult for financial advisors from a competitive standpoint, where an individual could say, hey, I've got 100,000 or $1 million. I can just shove it into a life insurance product. I've got this cash value asset that goes nowhere but up, and I take advantage of the tax benefits here. Oh, and the death benefits tax free, but typically they don't care about it. You know who took advantage of it more than anyone else that I heard of were construction companies prior to the MEC laws existing. They would just open a boatload of life insurance policies and just shove cash into them. So,
And
yeah,
I'm assuming because when you're building buildings, people do die on the job. And so if they're insuring, a lot of individuals, I'm sure they were receiving large payouts for people that are working on
yeah.
50-story, 70-story buildings, or,
So, yeah.
accidents do occur.
Yeah, interesting. Yeah, I'm sure that definitely played into it. It had nothing to do with the life insurance. It was before the MEC laws. What they were doing is just using it as a cash play. So I'm sure they cashed in a sense on that death benefit as well, if that ever happened. But 100%, just as far as a corporation, they plug money right into a policy, cash value, cash rich, asset in the balance sheet. They'd have access to it, tax free. MEC laws didn't exist. It was great. Obviously, the IRS looked at this and said, hey, this is not working. People are just putting money in here. We've got to do something to put some limitations on it. MEC law came out, and it is what it is today. And you can still, be creative with the design. You've got enough flexibility there where someone looks at a policy and says, okay, this will work. Like, I just have to know the ins and outs and how to set it up properly where it works for me, where long term I'm good, but I don't want to take this huge hit up front. That's why so many people run away from life insurance. Like, how do I get it cash rich up front?
Got it. Which
Yeah.
presents the different types of splits that different insurance agents use. So, for example, if I had,
Yeah.
if I'm a prospect, I'm a individual exploring this space. I have one individual saying, you can design a policy as a 90-10 split, 90% of my funding amount that I want to put in. So in my case, 70 grand, 63,000 going into a PUA along with a term rider,
Mhm.
7,000 going towards the base premium.
Yeah.
Then I can talk to another agent or do that same 70 grand and they give me a 35% base premium cost. So that would be 24,500 up front, day
Mhm.
one, right? And if I wanted to do a number, if I was to go that route, because I want to go long term,
Mhm.
you know, as you're saying, there would be like some requirement there to, like you said, either have a level term or an annual renewable term to
Yeah.
support that. But if I can do the same thing but have a cheaper cost, then my policy would internally grow more than someone that has, say, a $25,000
Oh,
base premium,
yeah.
right?
He,
And then the second piece to that is the bit of a risk in terms of having such a high base premium. You are locked into that number one.
correct.
And number two, what if you wanted to stop after 9 years?
Mhm.
So basically you overpaid by 14, I would say, let me see,
Yeah. You know,
by $17,500 per year, that individual overpaid versus me, right? So let's just say we got two examples. There's two Denzels. Denzel A, 70K, 7K premium. Denzel B, 70K with a 25K base premium.
Mhm.
We both want to fund it forever, but also want to have the window to stop at any point in time. Let's say 10 years down the road, we both stop because um, we, I don't know, retired, or we don't want to do it no more. We just don't want to
Yeah.
keep funding.
Hmm.
Well, 25,000 minus $7,000, that's 18,000 times 10 years. Denzel B pays 180,000 in base premium, whereas Denzel only paid $70,000
Yeah.
in base premium. Who wins in terms of cash value performance, especially if there's a reduced paid up option at the end of those 10 years? If I'm like, hey, I don't want to pay into it no more, who would win in terms
Yeah.
of cash value performance and, you know,
Hmm. Yeah. Assuming so just to clarify, the funding amounts, the net out of pocket and net time period is exactly the same.
exactly the same,
Yeah.
just the base premium is different.
Yeah, so the lower base premium is going to come out stronger almost every time. And when I say that, that's based off of uh, definitely based off of illustration, but in illustration, you can take it or leave it based off the present dividend values, guaranteed values. That'll always be the case if someone's very laser focused on the guarantees, which is good. I mean, it's a good way to set expectations. A minimum premium will give you more money. But here's my big thing is when you look at real data. So that I always talk about this, and I feel like sometimes I go too deep with it, is actual performance in the life insurance industry is so important to look at, yet it's so difficult to find sometimes. And when I say actual performance, you've got an illustration, but then you've got what's actually happening. And yeah, I've shared this with you before, and I share it with agents that we talk to. Agents call us all the time, and we'll always give them information, talk to them, no problem. I mean, we're big on transparency. When looking at actual policies, every company that's approached us before we sell their products or offer them or promote or push them heavily, my big thing to them is, hey, love the product, love the flexibility, love offering it as a tool over here, but the only thing I need to see in order to be able to do the best service for our clients, do you have any actual proof of performance that the policy is delivered a decent IRR? Because where people get disappointed in the insurance industry is they purchase a policy, they think it's going to produce X, it produces much less than that in reality because the illustration presented great numbers and then it under delivered. Client looks at it and says, like, what's going on? Like, I thought I would have this. And they're not mad at the company, they're mad at the agent. So my thing is like, no, I'm not doing that, and I wouldn't do it for myself. So companies that have provided actual proof and they update it on a regular basis, I've seen 4 companies consistently do it. And I say this all the time. You got Mass Mutual, Guardian, New York Life, and Northwestern Mutual. And I'll let everyone know, hey, regardless if you decide to work with me, whoever it might be, if your goal is to use a policy for retirement income, maybe it's just growing an asset in your balance sheet, maybe it's to practice the banking concept, whatever it might be, my goal is to show them how to maximize the cash value, short-term, long-term. Same thing with a death benefit. First and foremost, maximize the value, maximize the flexibility, and that's based off of policy design and companies that have been open and transparent and said, hey, here's our actual proof, not dividend history, real policies that have lived the test of time. And we've got some. The oldest one I have on record dates back to 1975, handful from the 1980s, and then we've had our own studies that are going on 7 and 8 years now where we track, here was what was projected when we put the policy together, here's what actually happened, and they're producing what they said they're going to produce, minus a little bit, as dividends have come down, but we're seeing them perform. I'm happy with the numbers. Everyone we work with is still satisfied. I'm like, okay, this is good. Because the reason why I do all that, and when we first connected, that conversation came up because you were presenting an illustration from a different company that looked phenomenal. I'm like, hey, they do present great numbers, but my only dig with them is, again, they haven't shown me any proof. I got to see the proof. Yeah, I have to see it before I put someone in a product and then they're going to be disappointed, potentially. So why I do all that, and I drive some insurance companies nuts when I keep asking them for the for the data, is one, when we worked with corporations, that happened. right? Corporations, a lot of times will work with the CFO, whether it's a corporation or a bank, for example. We just implemented a BOLI policy earlier this year, and they're pitched on and many times own cash value life insurance policies that have been on their books for a long period of time. They know what to look for because they're looking at the actual performance. They track it every month, let alone every year, like most individuals do. And the proof has to be there. If it's not there, they're not even going to consider that company. Like you got to have it. So one, copying corporations, copying the wealthy, that's what we'll look at when designing a policy and our company selection. Maximize the value first because you've got more money to work with for everything else. So that was the first thing. And then the second thing was just really experience and seeing what happened in the industry where people would buy policies and they would not produce what was projected on the illustration. The consumer thought that that would happen. This is what not any of our clients, but I've seen this happen many times. And they say, hey, like I thought I was going to have all this money and it's just underperforming. Like, should I even keep the thing? I'm not happy with it at all. And typically it was with companies that looked great on paper, but they didn't produce. Not to say though, nothing against smaller companies, nothing like that. It's just I haven't seen the proof. And that's all we want before we actually put those policies in force for someone. So we don't put someone in a position where they purchase a policy from you or I and then state, yeah, I thought I was going to have all this money, but it didn't produce. I'm unhappy with you guys now. It's a disservice. It's like, yeah, that's not what I'm after. If you do the right thing for people and set it up, maximize it, which by the way, always reduces the compensation to the agent every single time. If you do that, everything else works out. Consumers happy, you're happy. You don't have to worry about it. You don't got to sit there and, make up stories.
Yeah, no, I totally get it. So as we wrap up here, just to recap on some things as individuals are exploring this, even as myself, as I,
Yeah.
try to learn more and more about this concept as I'm practicing it, practically with running bills, running expenses, running, financing things, using it for business, things like that. When it comes to short-term versus long-term funding, you really can't go wrong if you do a long-term funding plan, right? I don't think you'll be frustrated if you know, designed a policy for a 30, 40, 50-year period
Yeah.
and then stopped at 30.
Mm-hmm.
Now, obviously, you would have paid for those additional 20 years that you didn't fund the policy for, right? Technically, in a way, because of the way the death benefit had to be set so high to support 50 years from the day you start the policy. So you
Yeah.
would have that to consider.
Mm-hmm.
So when I'm talking to clients, a healthy balance that I have thought of or found to have been effective, is I look at the person's age and when they desire to stop working, or if they use the word retire. I'm not
Mm-hmm.
such a big fan of retiring. I don't believe in that. There's no Hebrew word for it, biblically speaking. So, but say an individual says, okay, I'm 40 and I desire to stop working on my business or stop working at my job at 65, right? Well, then what I do is I say, okay, well, ideally you're going to work from 40 to 65, 25 years.
Yeah.
Okay, wonderful. Well, if we set a funding period for 25 years at the max amount with a reduced paid up option at age 65, or we leave the window open
Perfect.
to keep funding, but not at the max amount because maybe my income drops, right? Majority of Americans, their income drops when they retire. So now they're not obligated to, put in such a high amount, nor do they have to keep paying the term rider costs
Mm-hmm.
after that 25th year. So that drops off, the death benefit drops, MEC limit readjusts. We already overinflated the MEC, and now we're just straight guaranteed what the insurance company's policies are, which,
Hmm.
in this case with Guardian, it's 3x, not 4x. So 3x the base premium. So in my case, if I, 70K, 7 years after I'm done, I can put in 28,000. If I'm working with a client that's 40, they hit 65 years old, it's 25 years later, the thing's got like, 2 million plus in there in cash value. And then their max amount, drops down to what their, 3x the P, whatever that number is, say it's like 25K or whatever. Well, then they have the option. They're like, all right, I'm getting distributions from my 401k. I'm getting distributions from my IRA, my Roth, my this, my that, my HSA. All that money, I might as well just dump it into
Hmm.
the policy and keep earning more death benefit for as long as I live.
Hmm.
If I want to stop 1 year, I can. I can have my policy pay for the base premium. At that point, the policy is sustainable,
Hmm.
you know,
Hmm.
and in a nutshell, one could say, okay, long term in a way is more advantageous because you're removing the need to have a second policy,
Yeah.
to restart the whole process, have to
Right.
break through the first couple of years of insurance expense. You've locked in a great health rating at that time. Even if you did 10x your income or 5x your income or double your income, I usually tell my clients, hey, let's look at wife, let's look at husband, let's
Hmm.
look at son, daughter, cousin, nephew, brother, sister, mom, dad. Let's insure the whole household, or what I could say, the whole kingdom, right? Let's insure the whole kingdom before we get a second one on yourself, just so that we spread the insurability amongst everyone, especially if you put it on younger people. it, your cash is going to work even better for you, especially if you're the policy uh, holder, right, of someone else's policy. They're the insured. You're the policy holder.
Right.
You're in control of that cash. So
Hmm.
you can still use that person's cash value policy for your needs. And then when you pass away, it transfers to them.
Yeah.
And so you've perpetuated someone else's household
Yep.
in that sense. So I would look at it that way. So
Yeah. Beautiful. No, no, thanks for all that info. And I mean, I think it kind of speaks to your process and our process too, where there's no one way to do everything. Show the options. Show different companies. Show different splits, designs. Because depending on what company you want, based on flexibility and such, loan interest rates, non-direct, direct recognition, there's a lot of material. And the one thing that you just have to be aware of as a professional is if you show someone an option and then they see something else after the fact, even if that's not in their best interest, but they think it is, they can be upset. If I show you it, yeah, enough up front of everything and we're transparent, get the info there right away, and they don't get the sense that we're hiding something, even if we're not, they've got to be aware of that. Show everything. We started recently, and I think we're going to make this permanent in our process, disclosing, hey, here's the net compensation from any insurance company that's paid to the agent based off of a policy sale. There's
that's
nothing wrong.
awesome.
Yeah, nothing wrong with that. And
Talk
you
about
see,
transparency.
yeah, I mean, because like my goal when we started this, I mean, we're growing a business, and it's not just to make a ton of money. I mean, the money, like my wife and I, we live simply. It's like, who cares about that? We're trying to help people. That's the ultimate goal. Help those we work with, and then give people jobs here locally, whether they're on payroll, whether they're an agent, whatever it might be. And if you just do the right thing, providing the best possible service, like you're going to do fine. I'll tell anyone that in any business. Like just put others first, put them before yourself, do the absolute best job, be transparent with everything, and you'll be fine. So, I mean, if people want to know, I view it this way. Like you ever buy a car from a used car dealership, like how much is this guy really making? Why is this one $5,000 more than the dealer down the road? If everything is disclosed, including their commission, it's like, all right, I'm good. It's transparent.
Yeah,
If
very
it's not,
transparent.
you're like, is he doing something to me?
Right.
Yeah.
Right. It's like the famous I don't know if it was Jim Rohn or Zig Ziglar who said, help enough people get what they want so you can get what you want. Either it was
Okay.
Zig or maybe Bob Proctor. I forget who it was, but it was one of the greats.
Yeah.
Help enough people get what they want and you will get what you want,
Yeah.
you know. And guys like us that, we're we're also men of faith. I mean, we have a different agenda. You know, we're
Yeah.
we're we're more interested in eternity, right? We're interested in the greater things in life, greater
Yeah.
purposes. Money doesn't impress us in any way.
Yeah. Just a
Although we
bunch.
are great managers of it, you're a great manager of money and resources, as you should be, because you're a steward. Um, but it doesn't impress us. What impresses us is making impact
Yeah.
on clients, creating generational wealth, perpetuating kingdoms, um, lifting people out of poverty, creating jobs like you are
Yeah.
in your business, creating jobs, and having agents sell policies that obviously you could do yourself, but you delegate it to others, and you give them the same tools, the
Yeah.
same resources. This is something I found extremely difficult in the infinite banking space when I was searching, was the exclusivity to
Oh yeah.
become an agent, number one, but not just any type of agent, a insurance agent for the infinite banking concept, practicing that.
Mm-hmm.
The exclusivity just to get in is very hard. And if you are a person like myself that asks lots of questions, you tend to get shut out, because the
Mm-hmm.
moment I challenge something, and I'm very big on putting pressure on people's infrastructure and people's organizations, because I want to believe that you can handle my demands,
Right.
right? I want to make sure you can handle my requests. And and I want to have the same knowledge you have, because if you've got a gift and you share that gift with a second person and we come together, you and I both have the ability to help double the amount of people,
Sure.
rather than creating an exclusivity where you only give the Old Testament, but you don't give the
Right.
New Testament. It's like you don't give the whole sauce. You don't
Mm-hmm.
give it all.
Yeah.
Here's a little bit to get you by. You know.
Yeah, no, no, that's great. I mean, I agree. I mean, and I don't know that that's. I hear what you're saying, or could you, with your experience when you looked at that part of the industry before. I will let you know I've seen it in so many offices and agencies where it is, that exclusive, hey, it's the secret, hey, we only, write things a certain way. And if a client or consumer questions things or an agent questions things, that's partly why I work on my own now. I question things. I still do, and I was that annoying kid, and it just didn't work out. Um, but like I've seen, and we won't go into this maybe another time, stories where people would question their agent, like, hey, like, is there a way to set this up? Like, what's like the commission you make? And a client would tell me, like, the agent yelled at me. I'm like, what do you mean they yelled at you? Like, it's your money you're putting in. Like, no, no, here's exactly how it works. Transparency, just do to others as you would want done to you. That's all. But yeah, that stuff goes on. And I mean, it could be maybe the agent has a certain way of doing their business. They've done it very successfully for a long time, and it works for them. So there's nothing wrong. We don't want to put others down. I'm not into that. Um, but that stuff goes on, and like if you be transparent, do the right thing, and you'll continue to grow. And a lot of people will work with you. A lot of people won't, but that's okay.
Right. Well,
Yeah.
this has been awesome.
Yeah, man.
I think we were very productive on short term versus long
Yeah.
term, talking about those different types of term riders. You have level term or um, 1 year term, and understanding the costs of funding a long term policy versus a short term. Obviously, if you're doing a short term policy, it's going to be cheaper. If you do a long term, it's going to be more, but you, in a way, guarantee your health in terms of the price that you pay
Correct.
for while you're younger. So, healthy balance is you can do what I do. You look at how old you are now versus when you're going to stop working, and that can give you like a healthy funding period of, about how long you want to go for
Yeah.
the amount of cost that you want to pay for,
Yeah.
and still come out strong.
Mm-hmm. Right on. Right on. Well, thanks so much as always for your time. We are out of time today, but until next time, my friend.
God bless. Thank you.
Thank you. Take care, Denzel. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.